Welcome to EFRAG webinar. This is a live webinar, but it will be available on demand on EFRAG website later today. Today we're going to provide you an overview of EFRAG draft comment letter on the IASB discussion paper, Financial Instruments with Characteristics of Equity, or FICE. My name is Felipe Alves, Advanced Project Manager on FICE. And I'm here together with Vincent Papper, our Associate Director.
Thanks, Philippe. Good afternoon. Just a few words on the structure and overview of the content that we'll present during this webinar on the FICE project. It's just worth mentioning that this project addresses various complex accounting issues and also considers the information needs of users of financial statements related to complex financial instruments. Hence, we'll break down our discussion into different thematic areas, including initially providing an overview of the case for change of existing accounting requirements. And thereafter, we'll focus on the more specific topics that are addressed within the IASB discussion paper, as well as within our comment letter, the draft comment letter that is. EFRAG's draft comment letter expresses initial views on the IASB discussion paper, and it was issued in August this year, and it's open for comment until the 3rd of December. What we hope to achieve in today's webinar is to provide highlights of our comment letter, particularly in points that have generated considerable debate amongst our stakeholders. We also want to encourage stakeholder responses to both EFRAG and to the IASB discussion paper. In this webinar, we're expecting and we'll be responding to questions that the participants will pose to us. And this can be submitted at any time as we are making the presentation. Philippe and I will then be able to address the submitted questions when we get to the Q&A portion of this webinar, right after conveying the key highlights of the draft comment letter. But before we start, I'll just highlight the usual disclaimer. The views that we express are those of us as presenters, and they're not necessarily those of EFRAG. So with that, we'll get started. So Philippe, before we get to EFRAG's initial view in response to the discussion paper, perhaps you could just touch on some foundational aspects of the project. So why does the accounting distinction between debt and equity matter? And why is it an area of standard setting activity?
So currently the distinction between debt and equity is made under IAS 32, a standard which was issued back in 1995 and was subsequently revised in 2003. This distinction between debt and equity is very important because it can have a significant impact on the financial statement. For example, it can impact the company's ratios such as leverage, solvency, liquidity. It can also impact significantly the profit or loss of a company. So although this distinction is fundamental, it's not always easy to make it because a single financial instrument can have characteristics of equity but also characteristics of a liability. So as a result, in the last 15 years, the IAS 32 has been subject to a number of amendments and interpretations, which some of them introduced some exceptions to. In addition to this, the IFRS Interpretation Committee also received many questions on the application of IAS 32, particularly on derivatives on own equity, on issues such as the fixed for fixed condition. Finally, I would highlight that many complex instruments such as contingent convertible bonds or COCOs have been stretching the current requirements to their limits. So considering all these challenges, the IASB decided to publish a new discussion paper which explores a number of improvements to IAS 32. I think we can say that this discussion paper already benefits from the input received from previous discussion papers published by EFRAG and the IASB.
Mm-hmm. So you've touched on various challenges that are trying to be addressed. How is the IASB specifically addressing these challenges?
So the IASB is addressing these challenges in two ways. Firstly, by improving the classification requirements in IAS 32 and clarifying the underlying rationale of IAS 32. This without fundamentally changing the classification outcomes of IAS 32. Secondly, by exploring new presentation and disclosure requirements to address the limitations that exist currently on the binary classification model. So these are the two main approaches of the IASB.
Okay. I suppose there's a big question on whether IAS 32 needs to be updated. And a follow-up next question would be, if the IASB were to proceed with updating IAS 32, how would they go about it? So there'd be the question of whether it should be a narrow scope amendment, or should there be a more targeted approach, or alternatively, should there be a comprehensive clean slate type of approach? So what's IFRAG's view around the approach that the IASB should undertake, if at all it was to proceed with updating IAS 32?
So in our draft comment letter, we consider that indeed there is room to improve IAS 32, and that the IASB should continue to discuss this topic in the future. We also welcome the IASB efforts to improve IAS 32 without fundamentally changing the classification outcomes that we have currently. I recall that previous suggestions to fundamentally change IAS 32, such as the narrow equity approach or the loss absorption approach, were generally rejected in the past. So therefore, we generally welcome the IASB's efforts to improve IAS 32. Nevertheless, when considering all the IASB suggestions included in the discussion paper, EFRAG noted that the scope of the project seems to be very ambitious, particularly when we consider the IASB proposals and suggestions on presentation of equity instruments.
So if we're now to turn to the discussion paper itself, can you briefly describe the new principles that are being put forward for defining liabilities and equity?
Sure. So the key principles of the IASB new model are described in Chapter 2 of the discussion paper. It's really a fundamental chapter. In this chapter, the IASB identifies a number of key features that are relevant for the classification of financial instruments. So, for example, the IASB highlights the importance of providing information about when an entity should pay or has to pay, the timing feature, or what is the amount to be paid of the claim. This is what they call the amount feature. And based on these two features, the amount and the timing, the IASB provides new definitions of financial liability in equity instruments. Nevertheless, in the discussion paper, the IASB clarifies that under its preferred approach, equity instruments would be still the residual.
Okay. And what is IFRAG's view of what you've described as being the IASB's preferred approach, whereby the timing and amount features are considered to be relevant?
So, in our draft comment letter, we acknowledge that the IASB preferred approach is likely to provide more information to users and bring more clarity to some of the interpretation issues that exist currently with IAS 32. However, we also note that the discussion paper introduces extensive new terminology, and that this new terminology might raise new interpretation questions. It might also require preparers to invest significant time to go through all their contracts and assess whether there's actually a classification change, even if most classification changes are likely not to remain the same. And well, considering this, we suggested that the IASB should carefully consider the potential benefits of providing a better articulation of IAS 32 and the risk of disruption related to the use of a completely new terminology.
In terms of practical translation, how do the classification principles apply to different instruments? And where do we expect changes in classification to occur?
So the main principles are in Chapter 2, and then in Chapter, the IASB addresses the classification of financial instruments in three different chapters. In three sections. In Section 3, the IASB starts by describing how its preferred approach is applied to non-derivatives. So in the discussion paper, the IASB explains that we would not have a complete change of classification outcomes. For the non-derivatives, the classification outcomes are broadly the same as in IAS 32. However, we will have some classification changes. For example, the IASB often refers to instruments with cumulative features, such as the cumulative preference shares and the cumulative undated bonds. Such instruments under the IASB preferred approach would be classified as a liability because the entity has to pay a fixed amount on liquidation, and this is a change when we think about IAS 30, when we compare to IAS 32.
All right, so the cumulative instruments, the classification will change. What about putable equity instruments? I was just wondering, what is the reason for EFRAG support for the decision by the IASB to retain this particular exception? In other words, should there be any exceptions?
So at this stage, as you just mentioned, the IASB has decided to retain the IAS 32 putables exception. This exception basically allows an entity that issues financial instruments that are largely equivalent to ordinary shares to be classified as equity consistently across different entity structures. And we're talking about partnerships and limited life entities. So in our draft comment letter, we welcome the IASB suggestion to retain the existing exemption, the putables exemption, as the IASB new model would not address all the issues that gave rise to the exception in the past.
And earlier on, you articulated how their principles apply to non-derivatives. But could you be more specific on what EFRAG's initial views are as far as the new classification principles and how they apply to non-derivatives?
So in our draft comment letter, we highlighted that the classification changes suggested by the IASB are not related to problematic areas of IAS 32, at least for non-derivatives. For example, when discussing the problems of IAS 32 with our technical expert group, they did not mention about cumulative preference shares, for example, as a significant issue. Therefore, in our draft comment letter, we note that there is a need for the IASB to better explain why the benefits of such change. So, and also in the draft comment letter, we mentioned again the use of the new terminology when applied to the non-derivatives.
Okay. So you've alluded severally to concerns about the use of new terminology. Can you be a bit more specific on what these concerns relate to?
Sure. So here at EFRAG, we had long discussions with our expert groups about the amount feature and the timing feature that I just mentioned a few moments ago. So on the amount feature, we discussed whether and how it should apply to non-derivatives. For example, some consider that preparers would have to apply significant judgment when assessing whether an amount is independent of entities' available economic resources. So first, an entity would have to assess what are the entity's available economic resources, a definition which includes unrecognized assets, and this has been mentioned. And many consider that this terminology was also to some extent a bit confusing and circular because the definition depends itself on the definition of a liability. So there were also questions on whether this notion was simply related to share price or other elements of the financial statements. And finally, I noticed that even with simple instruments such as cumulative preference shares, there was a lot of debate about whether the amount actually was independent of the entity's available economic resources. So there was a lot of debate about the amount feature.
So you've highlighted the concerns you've had on the amount feature. What about the timing feature? Are there any concerns on that?
Yes, we also had long discussions on the timing feature. Some consider that it was inconsistent to focus on liquidation when companies actually prepare financial statements on a going concern basis. On the other side, our financial analysts also noted that for banks, it can be more a resolution rather than liquidation issue, and highlighted the importance of bail-in instruments. So this topic was so relevant that EFRAG included questions to constituents on this topic in its draft comment letter.
So based on what you said, classification may change for some non-derivative instruments. Now turning to derivatives of own equity, what's the IASB approach to these particular instruments and the classification? And also, what is the reason for a separate focus on these instruments?
Yes, these are special kind of instruments because many of the existing application challenges that exist today are related to the classification of derivatives on own equity, particularly on the fixed-for-fixed condition. So in section 4 and 5 of the discussion paper, the IASB explains how its model described in chapter 2 applies to derivatives on own equity, such as options to sell or buy own ordinary shares. So in section 4 and 5, the IASB is mainly focused on explaining how the timing feature and the amount feature apply to the classification of derivatives and compound instruments, provides new guidance that replaces the fixed-for-fixed condition, and provides new guidance on the accounting within equity when an entity enters into a derivative to acquire own shares. And also provides new guidance on financial instruments with alternative settlement options, including issues related to the measurement of the liability component. So all these new guidance is meant to address the issues that currently arise in practice.
So on the basis of that guidance, where will changes in classification occur for these instruments?
Again, the classification changes are limited. We are talking about fixed-for-fixed net share settled derivatives and the instruments that currently meet the foreign currency rights issue exception. So these are the two main changes in terms of derivatives on equity.
And does EFRAG agree with those particular proposed changes?
So in the draft comment letter, again, we question the relevance of the classification of suggested by the IASB. For example, according to the discussion paper, financial instruments that currently meet the foreign currency rights issue exception would be classified as a liability. The offer of rights in a foreign currency was particularly used in the financial crisis in 2008 and 2011 to increase the capital strength. At the time, there was a call for the IASB to classify such instruments as equity, leading to an amendment in 2009. And the proposals in the DP would, we can say, reverse such an amendment and require these instruments to be classified as a liabilities, but with the use of OCI. So we have expressed concern about such an outcome, particularly when we are not aware of any application issues with such an exception. And finally, more generally, we know that the guidance on derivatives on own equity would significantly differ in terms of terminology. For example, the IASB uses assets, equity transactions, liability, equity. Probably it will drop the notion of fixed-for-fixed condition and replaced by other terminology.
So the concerns you expressed earlier about the introduction of new language also extends to derivatives.
No.
Okay. As I understand, the IASB has also discussed the possibility of scoping out from ICE 32 all derivatives on equity. Why is this possibility being considered?
Yeah. When discussing the FICE project, the IASB considered the possibility of scoping out from ICE 32 all derivatives on own equity and classifying them as derivative assets or liabilities under the scope of IFRS 9. Some argue that it would be simpler or more conceptual to account all derivatives at fair value through profit and loss. This would also be in line with the view that many users that argue that think that such instruments, complex instruments, are classified as equity when actually they are not common shares. Considering this, EFRAG suggested that the IASB should further explore, further consider this approach, and we also have included questions to constituents on this.
Yeah. So wait to see what we hear from constituents. But still sticking to derivatives of own equity and written put options in particular, do you have any observations on the guidance on the redemption amount and accounting within equity?
So the IASB has provided new guidance on the accounting for the redemption amount and accounting within equity for instruments such. Currently, there is lack of guidance on this area, and this has been raising many different issues on initial recognition, measurement, presentation. These mainly for written put options. Therefore, EFRAG in its draft comment letter, we welcome the IASB discussion on the topic. However, we have raised some concerns on the proposed guidance on the accounting within equity. For example, we expressed concerns that under the IASB preferred approach, the accounting for a written put option would end up being very similar to the accounting for a convertible bond. That is, the equity component of a written put would actually reflect the embedded call option of a convertible bond. We consider that such an outcome can be complex for users to understand, and we also argue that such an accounting does not reflect the substance of.
What about non-controlling interest puts? That's NCI puts. How does IFRAG view the way that's been put forward by the IASB in its discussion paper?
So on the accounting of NCI puts, EFRAG welcomes the fact that the IASB suggested new guidance on this. The IASB approach is focused mainly on achieving consistency in terms of classification of different financial instruments regardless of how they are structured. Therefore, the accounting for NCI puts would follow the same principles as for the normal written puts. However, we notice in the draft comment letter that the IASB does not seem to address some of the conceptual and application issues that have been raised in the past and which led to the publication of a draft interpretation on the NCI puts. The IASB in the discussion paper clearly explains what would be the accounting, what is the new accounting, but does not clearly explain how this accounting would solve all these issues that were mentioned in the draft interpretation on NCI related to initial recognition, the recognition of NCI, subsequent measurement of the liability component, etc.
So there's still some outstanding issues. Yes. Then I would say you've covered a broad range of financial instruments and how classification will play out. Just to help tie together the classification part of this discussion, would you be able to convey whether IFRAG has a view on whether the proposed classification principles adequately resolve the areas where application challenges currently exist?
So in our draft comment letter, we have included an appendix, Appendix 2, where we make a fairly detailed initial assessment of whether the IASB addresses the issues that arise in practice. Basically, we went through all the existing interpretation issues and applied the IASB preferred approach to them. Well, the IASB new guidance on classification is likely to bring more clarity on some of the issues raised in the past. However, the IASB needs to assess whether the new terminology would introduce new interpretation issues, and this is one of the main comments that we make. So, until now I've been speaking a lot about classification. Could you provide us a bit of overview about presentation and disclosures? Why is it important to improve presentation and disclosure requirements?
Yep, it's good actually to switch gears to a different aspect of the discussion paper. I would say there's a general acknowledgement and consensus that there's only so much that users of financial statements can get from a binary classification of liabilities and equity. So clearly they need a lot more than just being able to look at the financial statements and make the judgment of whether a financial instrument falls one way or the other. And herein, you'd say presentation and disclosures have a key role to play as far as providing more information to users of financial statements. So presentation and disclosure is addressed within the discussion paper in sections 6 and 7, with proposals being made to enhance both the presentation and disclosure of both liabilities and equity instruments. Overall, IFRAG welcomes the proposals to enhance disclosures, particularly as equity disclosures tend to be a lot less comprehensive than those that relate to liabilities. So you've got lots of current disclosures, particularly when you look at IFRS 7 requirements. Liabilities tend to be addressed a lot more than equity instruments. Enhancing disclosure also aligns with meeting the information needs that investors in IFRAG's user panel have conveyed to us over the years. Our comment letter takes a more skeptical stance on presentation that's being proposed by the IASB. So we do welcome largely the enhancement of disclosures, but there's more of a skeptical stance towards the proposals around presentation. So there are various questions and concerns that we do raise.
But in terms of presentation, let's start with presentation. Can you provide us an overview of the IASB suggestions on presentation? Let's start with financial liabilities and then afterwards equity. So can you describe?
Indeed. So as I mentioned earlier on, this is addressed in section 6. And it does cover two financial statements. So the statement of financial performance and the statement of financial position. So the changes or the proposals that are being made for changes, they're not changes yet, but they're just proposals, relate to these two financial statements. And their underlying idea is really to provide more information about different types of financial liabilities. So as I mentioned earlier on, there's only so much you can get from a binary classification. And when you've got that, you'd have some instruments that would be close to the borderline. And one example, or at least some of these instruments, are described as financial liabilities with equity-like returns. The discussion paper proposes that there should be a separate presentation for this type of instruments. That's both on the statement of financial performance as well as on the statement of financial position. So on the statement of financial performance in particular, there's the proposal that the other comprehensive income statement should be applied to represent, or rather to have the measurements that pertain to the financial liabilities with equity-like returns. So for example, shares that are redeemed at fair value, that's just one example of those type of liabilities. So the revaluation or remeasurements that would pertain to this type of instruments would be presented in the other comprehensive income statement, the OCI that is. The objective of separate presentation is to avoid the counterintuitive depiction of performance of income and expenses of financial liabilities with equity-like returns. So they want to avoid a situation whereby the performance is distorted. So for example, if an entity incurs losses, losses are recognized in OCI, or rather, sorry,
profit and loss.
Profit and loss. Losses would be recognized in profit and loss in a situation where the entity is doing well. So that's an example of what's considered to be counterintuitive. So that's what the discussion paper is trying to avoid. Just briefly, I'll mention reclassification or recycling. So there is a prohibition of recycling of items from OCI to the profit and loss statement. So that's also put forward.
Okay. And what are EFRAG views on the IASB suggestions on the presentation of financial liabilities?
So I'll highlight three key aspects, particularly in respect of our position on the statement of financial performance. One is around the issue of counterintuitive representation of performance. So our commentator expresses the view that equity-like return patterns being presented in the profit and loss are not always counterintuitive. So we give the example of share-based payment expenses. When these are being represented in the income statement, that's not necessarily counterintuitive. So we express the view that the IASB needs to actually consider and to elaborate on this aspect of counterintuitive accounting, and looking at the depiction of gains and losses of own derivatives, to look at this issue broadly and see where it's applicable to particular financial instruments. Then there's the question of the use of OCI. The increased use of OCI is likely to evoke some unresolved conceptual questions. So for example, questions around what's the purpose and criteria of using the other comprehensive income statement. It'll also be the question of how should performance be defined. And then the third issue I'll raise would be around the question of recycling or reclassification from OCI to the income statement. So our comment letter views that the merits or otherwise of recycling have not been fully resolved. So for that reason, we do make a proposal that the IASB should consider disclosures which would convey what the reclassification amounts would have been had recycling been applied.
So we've been talking about the presentation of financial liabilities. The IASB has some suggestions on the presentation of equity instruments. So can you describe us what are the IASB suggestions on presentation of equity instruments?
So similar to the presentation of financial liabilities, this aspect of presentation is addressed in section 6 of the discussion paper. Before I mention what the IASB is proposing, I would mention that currently consolidated companies allocate the comprehensive income for the period between the group holding interests and the non-controlling interests. In section 6, the discussion paper includes the idea of allocation of comprehensive income to different classes of equity instruments with an update to their carrying value on the statement of financial position. The amounts that are allocated to different subclasses of equity will also be reflected in the statement of changes in equity. Now, this approach to allocating comprehensive income to the various subclasses of equity is also described as the attribution, the attribution mechanism or attribution approach. And the whole idea behind the attribution approach is to inform users of financial statements on the distribution of returns and wealth transfers that may be occurring across different subclasses of equity. The DP, the discussion paper, puts forward 3 methods of undertaking this allocation or attribution of total comprehensive income to derivative equity instruments. But in addition to the 3 methods, the discussion paper also considers only disclosing the attribution that would have occurred instead of presenting these in the statement of financial position and in the statement of changes in equity. I'd also mention that the IASB has not made a decision yet on which path it will take. So effectively, there are 4 options, the 3 methods and the disclosure-only option. But the IASB is waiting to hear from stakeholders on the way forward.
So we have described the IASB suggestions on presentation, but what are EFRAG views on presentation of equity instruments?
Our letter acknowledges that the attribution has some benefits, and there's some level of understanding also of this idea of depicting the wealth transfers across different types of subclasses of equity instruments. However, I would say there's an overall concern, which is really around the associated complexity if this attribution approach was adopted. There's a cost-benefit question in as whether the benefits of the information provided by the attribution approaches would actually exceed the related costs. Our letter also expressed varying degrees of concerns with the 3 different proposed attribution approaches. So there are questions on whether the information content actually fulfills its intended purpose. And we heard this from our experts group, who you mentioned earlier, the Financial Instruments Working Group, as well as the Technical Expert Group. So questions were being raised around the meaningfulness of the actual information that's conveyed by the attribution and whether it actually represents a wealth transfer. So there's almost a relevance type question there at play. Now, as a way forward, IFRAG recommends that the IASB should consider improvements to existing presentation requirements without undertaking the attribution mechanism. So we also mentioned that improvements should be considered for the reporting of earnings per share. That's within the IAS 33 requirements, as well as the suite of disclosures that could be enhanced. So if I was to summarize, I would say the initial view in our comment letter is that the idea of attribution across all classes of equity may be a step too far. But that being said, as we said earlier on, these are initial views that we are putting forward. And IFRAG is conducting an early impact assessment exercise, as well as undertaking outreach activities. So on the basis of that, we should be in a position to further inform our evaluation of the presentation proposals that are in the discussion paper.
So we have just covered a very important section, section 6 on presentation. So the IASB also discusses improvements to the disclosure requirements. Can you describe us a bit the IASB suggestions in terms of improving current disclosures and what are EFRAG views on them?
Indeed, disclosures are addressed in section 7 of the discussion paper. And there are 3 areas where the discussion paper puts proposals to enhance disclosures. One would be on priority on liquidation. The second would be on potential dilution of ordinary shares. And the third would be on the terms and conditions of financial instruments. As I've mentioned, IFRAG largely welcomes the enhancements that needs to be made for disclosures, particularly as you observe that for equity instruments currently, the disclosures aren't up to par. There needs to be an enhancement as far as that is concerned. On the specific proposals, I just mentioned the priority on liquidation. Our comment letter notes that considerations would have to be taken into account in terms of the reporting entity which is being considered. Such requirements should consider enhanced disclosures at an individual entity level, and if practicable, at the consolidated company level. So not just at the consolidated company level. We also support improving disclosures on potential dilution by providing the total number of ordinary shares that are outstanding. On this issue of disclosures around potential dilution, our letter discusses the scope of such disclosures. As we understand, IAS 33 only applies to shares that are publicly traded. So there'd be the question as to whether this scope would extend to separate and consolidated financial statements. Finally, I'll just mention, over and above what's been proposed, IFRAG makes or provides additional suggestions to improve current disclosures. And one example would be around the transfer of cash restrictions and wherever cash is locked in within subsidiaries. So that's one of the proposals we've put forward for enhancement. And I've covered disclosures, but there's one more section within the discussion paper. The last section. Indeed, and this is on contractual terms. So could you just maybe mention what is this all about and how does it relate to the range of instruments which we earlier addressed when we were talking about classification?
So yes, section 8 is the last section of the discussion paper, and the IASB discusses a number of topics related to the contractual terms, including whether economic incentives should be considered for purposes, whether indirect obligation requirements in IAS 32 should be retained, whether the classification of financial instruments should only be based on the contractual terms, and whether law should be considered or not. So on the economic incentives issue, we have discussed this issue many times with our expert group. Many consider that this was really an important topic, particularly for instruments that have alternative settlement outcomes. at the option of the issuer, because like a reverse convertible bond. So in general, we welcome the IASB discussion on the role of economic incentives. We also agree that economic incentives should not be considered for the classification purposes, because this would probably raise more questions than answers. Nonetheless, we've noted that improving the existing indirect obligation requirements in IAS 32 could help solving some of the challenges that exist today with the economic incentives. In terms of whether the law should be ignored for classification purposes, we also had long discussions with our financial instruments specialists on this topic, who raised many application issues on this area, particularly when referring to bail-in instruments that we have in Europe. And after all these discussions, EFRAG generally agreed or generally supported to retain the focus on the contractual terms for classification purpose. However, we highlighted challenges that arise in practice, we have described in our draft comment letter, and recommended the IASB to further discuss this issue with regulators and to analyze better the interaction between law and the contracts. So we have covered a lot of ground and highly complex topic.
Indeed. And our objective was really to present the highlights of our comment letter, which, as we mentioned, is a draft comment letter expressing initial views. And it's open for comments for financial reporting stakeholders until the 3rd of December. Before wrapping up, I would just like to say a few words on our focus while waiting for responses from our stakeholders. We are expecting stakeholder responses to our comment letter, and this will be a key input for the final EFRAG comment letter to the IASB. Our comment letter will also be informed by outreach activities, as well as by an early stage impact assessment. And the objective of the early stage impact assessment is really to assess the practical effects, the expected practical effects at this stage. So for preparers, there's a specific expectation around how the classification impacts may play out. And for users of financial statements, there'd be an expectation around what benefits they expect from the proposals that are being put forward. So we are currently conducting an outreach exercise, as well as undertaking an impact assessment exercise to assess these impacts of the new proposals. This will also feed into our final comment letter. Finally, I would mention, we also recognize that this is a highly complex topic, as is probably clear from the discussion we've had. And in that respect, EFRAG will be issuing bulletins for stakeholders. This is meant to help them in the assessment of the implications of the discussion paper. With that being said, I propose that now would be a good time for us to take some questions from the audience.
So I was actually, when you were just speaking, I was just going for the questions that I have here. So the first question that I have here, is it relevant for every entity or just the banks? This is a very good question. It will mainly affect companies with a complex capital structure and complex financial structures, particularly in terms of presentation and disclosures. Entities that issue ordinary shares and bonds to get finance would not be significantly impacted. Those that issue, for example, derivatives on own equity and perpetual bonds with contingencies, etc., those are likely to be more affected in terms of classification, presentation, and disclosures. But nevertheless, we would have to, in the future, assess whether, also in the impact assessment, whether this would have a significant impact or not on the financial statement.
I'll pick one here. This pertains to presentation. Do you also expect changes to the earnings per share, and have you already assessed that? What I'd say is that there's no clear-cut response to this particular question. It's also just worth mentioning the attribution approach that's being proposed within the presentation of equities. there are questions around whether this would affect the calculation of earnings per share. So that's not clear-cut at this stage. In our letter, we've recommended that consideration should be made around enhancing the reporting of earnings per share. But that's up for discussion at this stage.
Okay, now I'm going to look at another questions. Well, if the classification changes are limited, do we really need a change? Well, I've heard this question many times, and so the IASB preferred approach would require entities indeed to provide more information about their instruments, and it's likely to bring more clarity of some of the questions that went to the interpretations committee. I have already mentioned this before. And our main comment is that the IASB would have to consider the risks of disruption because of this use of the new terminology, and entities would have to review all of these contracts and assess whether there are classification changes. So there is a need for the IASB to think about the benefits of the new additional guidance against the use of new terminology and the risk of disruption.
What we have here. I think there's an interesting one here around, have you estimated how many companies will be affected? And again, this also touches on the impact assessment, which we are undertaking. I would say when you actually look at financial statements and when you look at the disclosures that are normally provided, it's quite challenging to, on an ex-ante basis, that's before the fact, to actually anticipate based on what the IASB has articulated within the discussion paper and based on the particular instruments that have been identified, you know, the ones that you covered, Philippe, where we expect changes in classification. But we know that we also go beyond those instruments that we've identified within this webinar discussion. One really has to look at the terms and conditions and see how that plays out with the classification principles. So in many cases, it's the respective entities that will know whether classification changes would occur. So it's quite challenging to make a judgment at an aggregate level, being outside reporting entities, how that would play out. We expect our impact assessment exercise to help in that respect, and we'll actually be conducting surveys to companies to try and get a sense at an entity-specific level what's the expectation around the impact of the discussion paper. So it's a very long-winded way of saying that it's hard to make an estimate at this stage, but the impact assessment exercise should help us have a sense, hopefully, of what the impacts would be.
So I've also seen here one question about IFRS 2, whether this IFRS 2 would be affected. So in 2019, the IASB will need to consider the feedback received from the discussion paper. Then it will have to decide whether it will change I-32 and also whether other changes are necessary, for example, the conceptual framework and possibly IFRS 2. But at this stage, the IASB is focused on I-32, and other discussions to other standards and conceptual framework would be addressed during the discussions on the feedback received.
Right. Let's see what we've got here. There's a question here, how is the discussion paper going to affect the average cost of capital? This is a tough one to tackle as well. Right? It's very much similar along the lines to the earlier question on what's our estimate of the number of companies that would be affected. Cost of capital, particularly when you're looking at that in the context of accounting requirements, first of all, there are two issues. One is when these accounting requirements come into place. This is a discussion paper. There's a question of whether the IASB will decide to change IS-32. That needs to be determined. And if it makes that decision to change IS-32, how long will that take to translate to an actual standard? When it translates to an actual standard, there'd be an implementation timeline. And then the practical implications for companies vis-a-vis the way they finance themselves, the type of instruments that they apply. Will that be affected by the new accounting requirements? It's very hard to make that type of determination at this stage. And in general, it tends to be very hard to make a linkage between accounting requirements and the cost of capital, because cost of capital is largely dictated by the economics of businesses, not by the accounting requirements per se. Accounting is just meant to reflect the economics of businesses. So at this stage, I would say it's a very difficult question to give a very straightforward answer to, because it's just too early in the process. And also, in a general sense, accounting requirements do not translate necessarily to an impact on the cost of capital.
I also have here one question about the effective date, given that we just have a discussion paper. So again, the IASB has published a discussion paper in 2019. The IASB will have to consider the feedback received. And then it will probably discuss the different sections probably in 1 year. Then it will have to decide whether it's going to publish an amendment or even a new standard, we don't know. And probably drafting this new standard and amendment, an exposure draft, we would first have to go through an exposure draft, and the IASB would have to decide probably whether it's more like a narrow scope amendment or a completely new standard. And afterwards, we would again have comments on the exposure draft. And so we're talking about a very long process that will not end in the next 4 years, for example, I would say. So it's very early to speak about effective date.
Yes. Any other interesting ones?
I also see what EFRAG has done to assess the use of this existing foreign currency rights issue exception. So this is a very good question. We actually, in Appendix 3 of our draft comment letter, you will find a link to our preliminary impact assessment we've done with an analysis for TAG. And there we explained that it was really difficult to get data from databases or even directly from financial statements because it's difficult to find in the databases or even within the financial statements where the companies are actually using the foreign currency rights exception. Sometimes we even try to look at the news items, etc., issued by the companies, but it was extremely difficult. So this is why during this consultation period we're going to make direct questions to prepare us on whether they use this foreign currency rights issue exception. So at this stage, it's very difficult for us to assess what is the impact, but with these surveys we hope that we will get more clarity. I don't know if you want to address another question or...
Have we addressed this one?
Yes, we have. I think we have addressed a couple of questions, unless you have a preference for any other.
Our responses have really, I guess, consolidated the type of questions that have come across. Yep, I'd say that's...
So I think that with this, we can close our presentation. Thank you for attending our webinar, and we are looking forward to receiving your comment letter.